Assalamu alaikum and Bismillahirrahmanirrahim. Good evening to everyone. Okay, in this video, we are going to discuss with the important adjustments of consolidation, and we all know that consolidation is very important with respect to financial reporting or F7 paper. So in this particular video, I'm going to discuss with all those maximum adjustment that examiner might ask you or can test you in your paper, in your final exams or in your F7 paper. So starting with that particular adjustments, let's start with all those particular adjustments. First of all, we are going to discuss with the important adjustments that is related to the CSFP, which means that is a consolidated statement of financial position. So in the first phase, we are going to discuss with the important adjustments or entries that is required or that need to be adjusted in the consolidated statement of financial position. And then in the second phase, we are going to discuss with the important adjustment that is related to the consolidated statement of comprehensive income. And then in the last phase, we are going to discuss with all those adjustments that is necessary to be made it out in relation with the associate company. So let's start with the first one. Okay, as we all know that I will try to definitely explain you each and every adjustments that we are going to make in that consolidated statement of financial position. The first adjustment that is related with the investment. We all know that while we are calculating the amount of goodwill, we need to calculate or we need to have an amount of investment, or we can say that the consideration transferred. There are certain or the particular adjustment that the examiner might ask you or might test you in relation with the investment. So let's start with that one. First of all, the first thing that examiner might ask you that if the investment is not recorded, the investment can be made in three ways. That is, number one, the cash investment. That is the cash investment. It means that investment debit and the cash will be credited in the accounts of a P company. That is investment debit and cash credit. That is the investment which is made it out in the form of cash. The other investment could either be that is the deferred consideration. For recording the amount of deferred consideration or for recording the investment that is made it out in the form of deferred consideration, and you must know about this one, that deferred consideration means the company or the entity or the parent company will pay the amount in the near future. It could either be after a period of 2 years, 3 years or 4 years in a next accounting period or in subsequent accounting periods. So it means the company P will be recorded as an investment debit and deferred consideration will be credited. But we all know that deferred consideration will be recorded at its present value. That amount, that is the investment debit and cash credit. What is that? That is the investment in the form of cash. Investment in cash. Now what is that? That is the deferred consideration, which means that the investment is made it out, and in deferred consideration it means the amount will be paid later on. So always remember, this will be recorded at its present value. And once we are recognizing that amount at its present value, it means now there will be a need of unwinding, and for that unwinding the adjustment will be made. That is, retained earning of a parent company will be debited and deferred consideration will be credited. This entry is made it out, or the adjustment is made it out, and that adjustment is for the unwinding of deferred consideration. But remember one thing, this entry will depend on the number of acquisition, number of years of acquisition. Which means, for example, if the entity or the subsidiary company was acquired 3 years ago, it means that adjusting entry will be made for a period of 3 years. It means that discounting or the unwinding will be made for a period of 3 years. And we all know that the unwinding of the year 2 would be the present value plus, that is, will add the interest or the unwinding of the year 1, which will make the total liability, and the discount rate or the interest rate will be applied. The unwinding of the year 2 will arrive, or the answer or the interest of second year or year 2 will arrive. Likewise, if you wanted to calculate the interest or the unwinding of the year 3, what will be the process? Present value plus the interest of the last 2 years, the total liability will arrive, and then you will apply the interest rate and the unwinding of the year 3 will arrive. So it means if you are making the adjustment of the unwinding, you have to make the adjustment for the year 2 or year 3 or year 4. Just because of it, because if you have acquired a parent or subsidiary company 3 years ago, it means unwinding will be made it out for 3 years. Okay, next. The third way of making an investment, that is the contingent consideration. Investment, debit and contingent consideration will be credited. Now what is contingent consideration? That is the consideration that is dependent on certain events. This will be recorded, and that is again the investment in contingent consideration, which means that the liability might increase or decrease in future depending on the events. If that particular event has arrived, it means now the contingent consideration might increase or it might decrease in future or at the date of reporting. That is the investment in contingent consideration. What if, for example, what if the requirement or the conditions that were given by the parent company have not met by the subsidiary company? Now the liability might decrease. In that case, at the end of the year, if the liability or the contingent consideration will decrease, so contingent consideration will be debited and retained earning of P company will be credited. This is the adjustment that might be required to adjust the financial statement of a P company. So the contingent consideration of P company will be debited and the retained earning of P company will be credited, and that is the adjustment of increase or decrease. There could be a vice versa situation as well. So there is an increase or there could be adjustment that examiner might test you, that is increase or decrease in contingent consideration. So that is the fifth adjustment that could be tested by the examiner in your paper. Another adjustment that was overall with the investment perspective. It means investment could either be made in the form of cash, it could either be made in the form of deferred consideration, it could either be made in the form of contingent consideration. So that was the investment side. Now let's move on towards the another side, that is the net assets. We all know that while calculating the amount of goodwill, we have two main line items, that is the investment or consideration transferred, and number two is the net assets of a subsidiary company at the date of acquisition. Now let's talk about the net assets of a subsidiary company. IFRS states that the net assets of a subsidiary company should be acquired at its fair value, it means at its market value. Four sort of adjustment might be tested in that particular area. Number one, that is the net assets of a subsidiary company might be recorded at its historical value or the book values, but we need to account it for at its fair value or the market value. It means now the adjustment will be required, and that adjustment is known as what the revaluation surplus adjustment. Second one is the subsidiary company might not have recorded the internally generated intangible in compliance with the IAS 38, but for the consolidation purpose, it's no more the internally generated, as we have acquired the subsidiary company, which means now that net assets are the acquired. It means that internally generated intangible is no more internally generated. Now it's a purchased intangible. We need to account it for in the consolidated statement of financial position. Third, that is the contingent liability of a subsidiary company. As per IAS 37, contingent liabilities should be disclosed. Yes, it's true, but for consolidation purpose, again, this is no more the contingent liability. Now the provision should be accounted for. Fourth, that is the inventory. As per IAS 2, subsidiary company must have accounted for their inventory at its lower of cost or NRV. If the cost is lower, definitely subsidiary company must have accounted for their inventory at lower of. But for consolidation purpose, it should be accounted for at its fair value, that is a market value. So adjustment is required. Now let's see what adjusting entries will need to be made it out. for those particular adjustments. First of all, if we talk about the revaluation surplus, we need to account it for the revaluation surplus, and the adjusting entry will be made it out. Property, plant and equipment of a subsidiary company will be debited and revaluation surplus will be credited. This is the adjustment, and that is known as what? The fair value adjustment. And that fair value adjustment need to be accounted for in the accounts or the books of a subsidiary company. Second, once we are recognizing that revaluation surplus in the books of a subsidiary company, another adjustment need to be done. The another adjustment would be the amount of depreciation that is to be recorded. Reason being, because subsidiary company has recorded the depreciation at its book value or the carrying value, but once we are making an adjustment, that is we are making or we are recording the assets at its revalued amount or the market value, it means the subsidiary company has recorded a lower depreciation in their individual accounts or the financial statement. So we need to account it for, we need to calculate the another or the excess or the amount of depreciation, that is a fair value depreciation, and the adjusting entry would be, that is that this will reduce the amount of retained earnings. This will reduce the amount of retained earning of a subsidiary company, as we are recording more depreciation, and definitely this will reduce the amount of property, plant and equipment of a subsidiary company. So that adjustment is known as fair value depreciation, that we are recording the depreciation on that particular fair value amount or the revalued amount or the revaluation surplus. Okay, another adjustment that need to be accounted for, that is the internally generated intangible. For that internally generated intangible, the adjustment will be made, that is brand debit and equity will be credited. Brand debit of S company and in the books of S company, and equity definitely will be credited in the books of S company. As we are recognizing the internally generated intangible, so brand will be debited as an asset and equity will be credited. And that adjustment is for internally generated intangibles. Okay, one more problem that will arise over here, that is if we are recognizing another asset, definitely there is no such asset being recorded in the balance sheet of a S company in earlier or the past years. So definitely once we are recognizing that particular intangible asset, so we need to recognize an amortization in this regard. So the impact of that amortization will be on the retained earning of S company. This will reduce the amount of profit of S company, and definitely this will reduce the amount of brand as well. So this adjustment relates to the amortization of internally generated intangible, amortization of intangible asset. That is the amortization that we need to record or account for in the consolidated statement of financial position. Now, one more thing that you need to keep in your mind, that is the fair value depreciation, and that amortization on the intangible asset will base or will be dependent on the number of years of acquisition. For example, if the subsidiary was acquired 2 years ago, it means we need to calculate the depreciation, we need to account for adjust the depreciation for the period of 3 years or 4 years, as the case may be. Same goes with the amortization of intangible asset. If the subsidiary was acquired 2 or 3 years ago, it means we need to account for the amortization for those particular years. Okay, let's move on to the another adjustment that is related to again the net assets of the company, of a subsidiary company, that is the contingent liability. What if the contingent liability was disclosed in the accounts of a subsidiary company? We need to account it for as a provision. Now, what accounting entry will be made in this regard? That it will reduce the amount. That is, how we going to record the provision? That is expense debit in the provision credit. But in the balance sheet, the impact will be on the retained earnings side. It means retained earning of a subsidiary company will be debited and provision will be credited or recorded. This adjustment is related to the contingent liability. As per IFRS, it will not be further recorded as a contingent liability. Instead, a provision should be recorded in the consolidated statement of financial position. Another adjustment is related to the inventory valuation. Usually, subsidiary company records the inventory at lower of cost or NRV. Lower of cost or NRV. It means lower of cost or NRV. Subsidiary company must have recorded the inventory usually at the cost, because normally the cost is lower. But here at the consolidated statement of financial position, now the adjustment will be made. For example, if the inventory was recorded at the lower and the cost was, let's say, 60 million, but now the market value of that inventory is 40 million, it means the inventory is recorded in the subsidiary company at 60 million, which means it is overstated, and it is overstated by 20 million. Which means now the adjustment will be made. Now the inventory will be recorded at the market value. So inventory is overstated, which means we need to reduce the amount of inventory. So inventory will be credited, and definitely retained earning of a subsidiary company will be debited with the amount of 20 million, for which the value the inventory is overstated or understated. And this could be a vice versa as well. Definitely you can do it. If that amount of inventory was understated, definitely we must have increase the amount of inventory and must have credited the retained earning of a company. So that is the adjustment related to inventory. So that was the net assets and the investment. It means whatever the adjustment we have made it so far, that all of these entries or all of these adjustments are related first with the investment and secondly with the net asset side. So these were the adjustment that is related. An examiner might test you for these adjustments. Now moving on, let's move on towards another area. And now we are going to discuss about the adjustment that is related to impairment. There could be an adjustment that examiner might test you, that is for the adjustment of impairment. Now what entry will be made in this regard? So the adjustment could be that is the impairment of goodwill. So adjustment will be recorded as group retained earning will be debited along with the NCI, and goodwill will be credited. Now the point should be noted, and there should be a noting point, that is the impairment of goodwill. That is the adjustment related to impairment of goodwill. But one thing that should be kept in mind, that NCI will only be debited if the company is using the fair value method for the calculation of goodwill. If the company is using the proportionate method, definitely no NCI will be debited. Let me prepare the entry for this one as well. Then only the group retained earning will be debited and goodwill will be credited. That is again the impairment of goodwill, but in this entry we are assuming that we are using the proportionate method for the calculation or for the calculation or evaluation of the goodwill. Okay, another adjustment that examiner might ask you, that was the, I guess, adjustment number 12. Yes, 12 and 13. Okay, another adjustment that examiner might test you, that examiner might ask you, that is the cash or inventory in transit. For example, if there is a difference of receivable and payable between the parent and the subsidiary, that is the intra receivable, intra payable. For example, P company owe $5,000 to S company, but the receivable account of S company shows 7,000. It means receivable is more than the payable of a P company, which shows that there is a cash in transit in between the two companies. So we'll be recording and we'll be assuming that the cash has been received. So cash debit and account receivable, this adjustment will be made, and that adjustment is related to the cash in transit. There could be another adjustment. There could be another adjustment. That is the inventory in transit. For example, parent company dispatched of inventory to the S company, but the S company has not yet received the amount of inventory. So an adjustment will be made, that is inventory debit and accounts payable credit. Inventory debit and accounts payable credit, that is the adjustment for the inventory in transit. Once you have adjusted both the accounting entries, that is cash debit and account receivable credit, inventory debit and account payable credit, and now you will be making another adjustment, that is for the intra receivables and intra payable, needs to be set it off, needs to be adjusted off. Now the final entry will be made for the accounts payable debit and accounts receivable credit. Please keep one thing in your mind whenever you have cash in transit as well as the inventory in transit. First of all, you need to adjust both the entries, and then you are going to set off the accounts payable and accounts receivable. Many of the times it's seen that the candidate, what the candidate normally perform or they do what, that they first of all they just set off the account payable and account receivable. This is not the right case. This is not the right way. First you need to set off, or you need to adjust the cash in transit, inventory in transit, and once you will do it, then you have to set it off the accounts payable and accounts receivable. So that is the intra receivable and intra payable, intra receivable and intra payable, intra receivables and payables will be set it off, will be set it off. So that was the intra-group. These are the adjustments that we are now discussing. That is from 14 onwards. These are the intra-group items. These are the intra-group items that we are right now discussing. Now another adjustment that a company might make, that is for another adjustment that company might record, that is the URP, unrealized profit. Now what is unrealized profit? If the parent or subsidiary have sold some goods to another company, this could be a vice versa, and if those goods are unsold at the end of the accounting period, and if those goods are unsold at the end of the accounting period, which means now the unsold goods must have certain profits. Those unsold goods must have certain profit, and now that profit is known as what? Unrealized profit. For those unrealized profit, IFRS has recommended these unrealized profits needs to be adjusted off. These unrealized profit needs to be set it off. These unrealized profit needs to be cancelled off. Okay, so how are we going to remove that unrealized profit? But it depends. It depends. For example, if the URP, that we are talking about the URP of inventory. URP of inventory. For example, if the goods are sold by subsidiary to parent, now the accounting entry would be retained earning of S company will be debited, as because the unrealized profit in the books of a subsidiary company, retained earning of S company will be debited, and inventory of P company will be credited. Inventory of P company will be credited. And we all know that retained earning of S company can only be found in the net assets working. So this adjustment will be made in the working of our net assets. Okay, what if the goods are sold by unrealized profit? We are talking about the unrealized profit of inventory, but the goods are sold by parent company to a subsidiary company. Now what accounting entry will be made? Now the profit will be removed from the balance sheet or the accounts of a P company. It means retained earning will be debited and inventory of S company will be credited. Inventory of S company will be credited. And we all know that retained earning of a parent company can only be found in the working of group retained earning. So this profit will be removed from the group retained earning. So that is the unrealized profit of inventory. What if S or subsidiary company sold goods to P company, and what if the parent company sold goods to a subsidiary company? This is the intra-group trading. These adjustments were related to the intra-group items. Okay. But this is not the end. This is not the end. Let me tell you one thing. That what if there is unrealized profit related to the transfer of asset? Yes, this could be an option. This could be a reason. This could be an adjustment that examiner might test you for. For example, if the parent company or subsidiary company transferred a non-current asset, if a subsidiary company transferred a non-current asset to a parent company and recognized a gain on disposal, for which we are talking about, that is the gain on disposal, IFRS states that it's not a gain on disposal, it's an unrealized profit, and again that needs to be eliminated. And that unrealized profit on the transfer of non-current asset. For instance, if the subsidiary transferred the non-current asset to P company, now what accounting entry will again be made? That is the retained earning of again S company will be debited. Retained earning of S company will be debited, but this time non-current asset of a P company will be credited. And again, if we are talking about the retained earning of S company over the subsidiary company, it means we'll be making an impact in the net assets working. Okay, but again, this is not the end. There is another problem. If the subsidiary company has transferred that asset to a P company, and definitely P company has recorded that particular non-current asset on a sales proceed value, which means P company has recognized that gain on disposal or URP in the value of non-current asset, which means the non-current asset of a P company is overstated. This will result into a higher depreciation in the accounts of a P company, which means the P company has recorded the higher depreciation. Now this need to be accounted for. We need to reduce the amount of depreciation. In order to reduce the amount of depreciation, we need to increase the amount of profit of a parent company. Now there will be another adjustment, and that adjustment is known as excess depreciation. Excess depreciation. For instance, if the non-current asset was sold by subsidiary to parent, now the adjusting entry will be made, and now the non-current asset of a P company will be debited. It means you need to increase the amount of non-current asset as you have recorded the higher depreciation, because of which the non-current asset value has been reduced. So non-current asset of a parent company will be debited and retained earning of a parent company will be credited. But remember, this adjustment will be made. With the amount of URP, or we can say that the gain on disposal, with the amount of gain on disposal, or you can say that with the amount of URP. And that second adjustment will be made with the amount of depreciation. But one thing that should be kept in mind, that the depreciation will be adjusted for the number of years. For example, number of years transferred. For example, the asset was transferred 2 years ago. It means now the excess depreciation will be adjusted for 2 years. That is, the depreciation will be multiplied by the 2 years. So that was the adjustment. Okay, now there could be an alternate. There could be a vice versa. There could be a vice versa situation. And what if the goods are sold by net as non-current asset is transferred by parent to subsidiary. Non-current asset is transferred by parent to subsidiary. It means now unrealized profit on the transfer of non-current asset will be eliminated. How this is gonna to be eliminated? Now the retained earning of P company will be debited and non-current asset of S company will be credited. Another adjustment that we need to account for. And what is that another adjustment? Again, for the excess depreciation, as S company or subsidiary company has recorded the asset at the higher value, which means that need to be adjusted. Now the excess depreciation will be adjusted. Remember what will be the adjustment? If P transferred the asset to S company, so the adjusting entry would be non-current asset of S company will be debited and retained earning of S company will be credited. And always remember, whenever the retained earning of S company is being affected, it means that adjustment will be made out in the net assets working, so that is the adjustment that need to be accounted for in the accounts of a subsidiary company and the parent company. Okay, so these were the adjustments these were all the adjustment that is related to the balance sheet side only. These were all the adjustment that is related to the balance sheet side. One last adjustment that examiner might test you for this, that is if you need to calculate in the mid-year acquisition, in a question of a mid-year acquisition, you need to calculate the retained earning at the date of acquisition, and for that we have a formula to calculate, that is retained earning opening balance at pre-acquisition profit, or there could be an alternative formula for the calculation of retained earning at acquisition, that is retained earning closing balance less post-acquisition profit. So this could be a working or the formula that should be applied in order to calculate the retained earning at the date of acquisition. Okay, one more thing that I should account for this one, that is in order to calculate the amount of investment, there are 4 sort of investment that examiner might test you. Number 1, that is the cash investment. Number 2, that is the deferred consideration. Number 3, that is the contingent consideration. And number 4, there could be another adjustment, and I'll just make it out and I'll just record it over here, and that is the share exchange. Please note it down. That is investment debit and share capital or share premium will be credited. Investment debit and share capital and share premium will be credited. That is the adjustment that examiner might test you for the calculation of investment. Now, why I'm focusing more on the entries? One thing you just keep in your mind, while you are having a question, once you are having a question of consolidated statement of financial position, what I recommend to all my students and the candidates, so please make adjusting entries on a rough paper. What will be the benefit of it? For example, while you were calculating the amount of goodwill and you just had an impairment loss, what you did, you recorded an impairment, or you just deducted the amount of impairment loss while calculating the amount of goodwill. But remember, the impact of that impairment loss will be on the group retained earning and as well as on the NCI side. So it means there will be an impact on 2 workings, that is the group retained earning and the NCI. So far, when you will calculate the amount of goodwill, definitely you will jump on to the net assets working, and afterwards you will be jumping on the investment and associate working, and then you will be moving on towards the group retained earning side. So far, until you will reach to the group retained earning or the NCI working side, you might forget to adjust or to deduct that impairment loss from the group retained earning. Many of the candidates or students make a blunder. They know it, each and everything, that this should be adjusted from the group retained earning side, but they forget to adjust it. Another example, while calculating the amount of investment, you made an adjustment that there will be an adjustment of deferred consideration. For example, retained earning debit, unwinding of deferred consideration. Retained earning will be debited and deferred consideration will be credited. You will prepare the balance sheet, CSFP, finally at the end, just at the end of the question. And while you're preparing the CSFP, there is a probable chance that you will forget to add those deferred consideration values in the consolidated statement of financial position. So in order to memorize, in order to retain all of those adjustments, you need to make all of these adjusting entries. These are the tools through which you will remember. Once you will make all of these or the relevant entries that is being tested in your paper, once you will make all of these adjusting entries in a rough paper, you will remember that you need to adjust all of these adjustments. Once you will adjust, just cancel off all these entries which you have made on your paper, rough paper. So please make entries while you are attempting, while you are working, while you are solving the question, whenever you see that there is an adjustment of investment, just hold on, make an entry of it, and then calculate your investment amount. Once you saw that there is an impairment of goodwill, now while eliminating the amount of goodwill, while recording the amount of impairment loss and the goodwill working, just hold on, have a pause on it, go to the rough paper, make an entry of it, come back again and calculate or finalize the working of goodwill. This will help you out, and after having a practice of it, you will definitely never forget to adjust these adjustments in the upcoming workings or in the preparation of the consolidated statement of financial position. So these were the adjustments that was related to the consolidated statement of financial position. In the next video, inshallah, we'll let you know and we'll give you an idea for the consolidated statement of profit and loss, that what sort of adjustment that examiner might ask you or test you in the consolidated statement of profit and loss account. Till that, thank you so much. Take care. Goodbye.